The markets are absolutely buzzing today with major action across stocks, bonds, currencies, and commodities. Not to mention some big decisions coming from central banks all around the world.
Definitely a day to be paying attention. Lots of moving pieces, lots of interconnected factors at play.
Let's start with the inflation data came in as expected, which seems to have given investors a boost. The NASDAQ even closed above 20,000 for the first time ever.
Wow, that NASDAQ milestone, that's a huge psychological barrier. Breaking above 20,000, I mean, that really suggests that investors are feeling very bullish, very optimistic about the future of tech. Even with a Fed rate cut looming, this could signal a continued surge, particularly in those tech stocks focused on those emerging technologies like AI and sustainable energy.
Speaking of the Fed, traders seem to be pricing in a quarter-point rate cut on December 18th as a near certainty.
Yeah, the rate cut itself is almost baked in at this point. I think the real question is, what will Fed Chair Powell signal about their future intentions? Will this be a one-time adjustment or the beginning of a more dovish stance? I think the markets will be scrutinizing every word of their statement for clues.
Across the pond, the European Central Bank is also expected to cut rates today. There's a lot of focus on what ECB President Christine Lagarde will say about the economic outlook.
The ECB is facing a real dilemma. They need to balance those concerns about slowing growth in the Eurozone, right, with the political headwinds that they're seeing in France and Germany. Plus, you've got those potential trade tensions with the incoming U.S. administration. It adds another layer of complexity. Her comments today, they could either soothe the market anxieties or further fuel that volatility.
Lagarde's pronouncements always seem to have the power to move markets. Meanwhile, the Swiss National Bank threw everyone a curveball by slashing interest rates by 0.5 point, their biggest cut in nearly a decade.
Yeah, the Swiss franc obviously took a hit, weakening against both the dollar and the euro. I mean, this aggressive move, it shows just how worried the SNB is about slowing growth and low inflation in Switzerland. They're really trying to stave off those deflationary pressures and stimulate their export-oriented economy.
Makes you wonder if this is a sign of what's to come from other central banks. Are we entering an era of bolder monetary policy decisions?
It's certainly possible. Central banks around the world are walking a tightrope. They're trying to support economic growth without letting inflation get out of control. And I think the SNB might be setting a precedent here for more drastic action if needed.
Now, shifting gears to currencies, the U.S. dollar eased somewhat after that inflation data, but rising Treasury yields seem to be preventing a sharper decline.
It seems like there's some competing forces at play here. On the one hand, you've got that inflation data. Typically, that would weaken the dollar. But at the same time, you have those rising yields on U.S. Treasury bonds. They're attracting those foreign investors seeking higher returns. It's a classic example of just how interconnected those global markets can be.
The Japanese yen held steady against the dollar, likely influenced by reports that the Bank of Japan might hold off on an interest rate hike. What's your read on that?
The Bank of Japan is definitely in a tricky spot. I mean, they've been battling deflationary pressures for years, and a rate hike, I think it could really exacerbate that. It seems that they're prioritizing stability for the moment, but if inflation starts to pick up, they might have to reconsider.
On the other hand, the Australian dollar got a nice boost from those positive employment figures. It had been struggling lately due to concerns about that Chinese yuan potentially depreciating.
The Aussie dollars is often seen as kind of a barometer for the Chinese economy because of their close trading relationship. So any wobble in the yuan, it tends to have a ripple effect. Those strong employment numbers in Australia, though, they really help to kind of counteract those concerns.
And speaking of the yuan, it remained fairly stable after the Chinese central bank kept the official midpoint for that currency unchanged.
That was a pretty widely anticipated move. I think the Chinese government wants to maintain stability, especially with the ongoing trade negotiations with the U.S. A sharp depreciation could really escalate those tensions and disrupt those global trade flows.
All right, let's move on to oil prices. They're continuing to climb, driven by those concerns about potential sanctions on Russian oil production.
Energy markets are always sensitive to those geopolitical events, and Russia's obviously a major energy player, so any disruption to their exports can send shockwaves through the global energy system. These potential sanctions, they're just adding fuel to the fire, so to speak.
And lastly, gold prices briefly touched a one-month high today. It seems investors are looking for safe havens amid all this uncertainty.
Gold is a classic safe haven asset. When investors get worried about economic or political turmoil, they often flock to gold as a store of value. too. And, that anticipation of further Fed rate cuts, which could potentially reduce the attractiveness of bonds, I think might be adding to gold's luster right now. I think these currency fluctuations are just a reminder of, how dynamic the global financial system really is.
Yeah, it's like a giant game of financial musical chairs with everyone trying to find the best seat before the music stops. But those currency moves can have a huge impact on trade and investment.
Absolutely. A strong currency can make your exports more expensive, hurting your competitiveness in global markets. Conversely, a weak currency can make imports more costly, potentially fueling inflation.
So, for example, if the dollar weakens, American products become more affordable for buyers overseas, which could boost U.S. exports.
Precisely. But a weaker dollar also means that those imported goods become more expensive for American consumers. So it's kind of a complex equation with winners and losers on all sides.
Going back to the Swiss National Bank's surprise rate cut, some analysts are applauding their bold move, while others are questioning its long-term impact.
It was certainly unexpected. The SNB is clearly prioritizing economic growth over concerns about currency devaluation. They're hoping to stimulate borrowing and investment by making credit cheaper.
But couldn't that also lead to higher inflation down the road if their economy heats up too quickly?
There's always that risk. But the SNB seems to be betting that the benefits of boosting growth outweigh the potential downsides of inflation. It's a delicate balancing act, and only time will tell if they made the right call.
It feels like central banks all around the world are kind of in uncharted territory.
Yeah.
There's no playbook for this kind of global economic uncertainty. They're making it up as they go along.
That's a fair assessment. I think we're in a period of unprecedented interconnectedness and volatility. The old economic models might not apply anymore. Central bankers are having to adapt and innovate on the fly.
So if you're an investor or business owner trying to navigate this landscape, what's the best course of action?
The key is to stay informed, diversify your investments, and be prepared for the unexpected. Don't put all your eggs in one basket. And remember that flexibility and adaptability are essential in a world where change is the only constant.
Sound advice. Now let's drill down into the oil market. Prices are continuing to climb, fueled by those concerns about potential sanctions on Russian oil.
Energy markets are always sensitive to those geopolitical events, and Russia is a major energy player. So any disruption to their exports can send shockwaves through the global energy system.
And these sanctions are being considered at a time when global demand for oil is already high.
Exactly. We're seeing robust economic growth in many parts of the world, which is driving up energy consumption. Add to that the potential for supply disruptions, and you have a recipe for even higher oil price.
What does this mean for consumers? Should we expect even higher prices at the gas pump?
It's certainly a possibility. The price of crude oil is a major component of the cost of gasoline. If those prices continue to climb, it's likely to hit consumers' wallets.
Not good news for anyone trying to fill up their tank. Let's end on a slightly more positive note. Gold prices are up, which suggests that some investors are still feeling optimistic despite all the uncertainty.
Gold is often seen as a safe haven asset, so its price tends to rise when investors are feeling nervous about the economy or the stock market. The fact that gold is performing well could be a sign that investors are hedging their bets, but it doesn't necessarily signal a lack of confidence in the broader economy.
It's like they're saying, we're a little cautious, but we're not hitting the panic button just yet.
Exactly. It's a sentiment of cautious optimism. They're acknowledging the risks, but they're not giving up on the potential for growth.
That's somewhat reassuring. We've covered a lot of ground today, from central bank decisions to currency fluctuations to oil price spikes. The global markets are certainly keeping us on our toes.
It's a dynamic and ever-changing environment, which makes it both challenging and fascinating to analyze.
Speaking of dynamic, let's take a look at the bond markets. Bond yields have been on the rise lately, particularly in the U.S. What's driving that trend?
Well, there are a few key factors at play. First, we have that inflation data we discussed earlier. When inflation is heating up, investors demand higher yields on bonds to compensate for the erosion of their purchasing power.
So it's a way to protect themselves from that rising cost of goods and services.
Precisely. Second, we have the expectation of continued economic growth. When the economy is expanding, businesses are more likely to borrow money to invest and expand, which increases that demand for credit and pushes up interest rates, including bond yields.
It's like a bidding war for capital,
Right,
with borrowers competing for funds.
You could say that.
Yeah.
And lastly, we have the Federal Reserve's monetary policy. The Fed has been gradually raising interest rates over the past few years to keep inflation under control. Those rate hikes have a ripple effect throughout the financial system, including the bond market.
So it's all interconnected. A rate hike from the Fed can lead to higher bond yields, which in turn can affect borrowing costs for businesses and consumers.
Exactly. It's a complex web of relationships, and it's important to understand how those connections work.
And what does this mean for investors? Should they be concerned about rising bond yields?
It depends on their investment goals and risk tolerance. Rising bond yields can be beneficial for investors who are seeking higher returns. However, they can also increase the risk of losses if interest rates rise too quickly.
It's all about finding the right balance between risk and reward.
As with any investment, it's crucial to do your research, understand the risks, and make informed decisions.
Speaking of informed decisions, we've covered a vast array of topics today, from inflation and central bank policies to currency swings and oil price dynamics. It's been a whirlwind tour of the global markets.
It certainly has, but I hope it's been an enlightening one.
It has been. The key takeaway for me is the interconnectedness of everything in the global economy. What happens in one corner of the world can ripple outward and affect us all.
I couldn't agree more. We live in an increasingly complex and interdependent world, which presents both challenges and opportunities.
It's a reminder that we're all part of this global financial ecosystem.
Exactly. And what happens in one market can have these cascading effects across the globe. Take the recent surge in oil prices, for instance.
Driven by those concerns about potential sanctions on Russian oil, right?
Precisely, higher oil prices don't just affect drivers at the gas pump. They ripple through the entire economy, increasing transportation costs for businesses, raising input prices for manufacturers, and ultimately contributing to broader inflationary pressures.
So it's a chain reaction that can impact everything from the cost of groceries to the price of airline tickets.
Absolutely. And that's why it's so important to understand these global interconnections. They can have a very real impact on our everyday lives.
Now let's shift our focus to gold. You mentioned earlier that gold is often seen as a safe haven asset. Can you elaborate on that?
Gold has a long history as a store of value, dating back centuries. When investors are worried about economic instability, political turmoil, or even just a volatile stock market, they often turn to gold as a way to preserve their wealth. It's seen as a tangible asset that holds its value over time.
So it's like an insurance policy against uncertainty.
In a sense, it is, and that's why we often see gold prices rise during periods of heightened risk aversion, as we're witnessing now.
But gold doesn't generate any income or dividends. So why would investors choose it over other assets?
That's a good question. Gold's appeal lies in its perceived stability and its ability to hold its value in the face of those economic or geopolitical shocks. While it doesn't generate income like stocks or bonds, it can act as a hedge against inflation and currency devaluation.
So it's a way to protect your purchasing power over the long term.
Precisely. And for some investors, that peace of mind is worth more than the potential for high returns from riskier assets.
Well, we've covered a lot of ground today. We've analyzed central bank decisions, dissected currency movements, explored the energy markets, and even delved into the world of safe haven assets. It's been a fascinating journey through the global financial landscape.
It certainly has. And it highlights the importance of staying informed and adapting to a constantly evolving market environment.
Absolutely. So as we wrap up this episode, I want to leave our listeners with one final thought. In this complex and interconnected global market, knowledge is power. The more we understand about how these forces interact, the better equipped we'll be to navigate the challenges and seize the opportunities that lie ahead.
I couldn't agree more. It's all about staying curious, asking questions, and continuously expanding our understanding of the world around us.
Well said. And on that note, thank you for joining us for this insightful exploration of global markets.
It's been a pleasure as always.
Goodbye, and see you in the next video.